All right, guys, thanks for joining us again this week. We are going through our QuickBooks Enterprise series of trainings. Last week, we talked with Webgility. If you missed it, please let us know. We can definitely get you over that recording, talking about the state of e-commerce, and there's going to be more to come with that because there's just so much going on, right, with moving to the more online space. But this week, we're going to be talking about accounting for, or accounting and, or however you want to put it, inventory. I'm Marjorie Adams. I'm the CEO of Fourlane. I love hosting these every week. My passion is to educate and provide opportunity, and so that's what we're going to be focusing on today. So when I first started in the consulting space, I was very lucky. I got introduced into accounting at a manufacturing company. That was my first time learning anything accounting. And I got even more fortunate than that because I actually had manual books, right? Like the big paper ledger books that we wrote in pencil and erased sometimes, like super weird, no audit trail. Even thinking about it gives me the chills a little bit now. But it was a great experience. We also had 100,000 square feet of inventory. Some of that inventory was used in manufacturing. Some of it was sold wholesale. Some of it was sold retail through eBay even back then. So just some really cool experiences in dealing with inventory. We would get pallets of things received in the dock, and we would buy by the pallet and then have to price out the inventory items and assign costs across the items. Anyway, it was really neat, great exposure. But to me, inventory was just, it was learning a lot, but it was just part of the job. Then when I entered the consulting space, what I found out is a lot of people don't like to touch inventory. And I don't really understand why. So I guess I kind of understand a little bit why, let's be clear. Because there's a lot of different ways you can value inventory, right? You can do FIFO, you can do LIFO, you can do perpetual, you can do stated. There's a lot of different ways that you can value inventory. And it does take quite a bit of strategy of looking at why am I valuing my inventory in this way in order to decide. And so that can be difficult. And also there can be tax benefits to possibly value an inventory a certain way versus another way. And you have to declare your inventory valuation method. So there's a lot of things that can go into it. But today what we're going to be talking about is basically just breaking it down. When we bring people on board here as consultants, a lot of times they don't have a tremendous amount of experience in inventory. And that's one of the things when somebody comes on board here at Fourlane, they go through kind of a crash course in inventory in the very beginning. And the people who come out of it the fastest, right, who understand things the best when it comes to training them in inventory are the people who understand the debits and credits. So that's what we're going to be focusing on today. Let's follow the money, the debits and credits, and hopefully that'll help things to click a little bit more. Hopefully that makes sense. If you have any questions throughout the today, there's a lot to go over, so I probably won't get to them till the very end. If I don't get to them at the end, stick them in there. We will make sure to follow up after the webinar and get you answers to questions, or possibly turn them into future webinars as well. So if there's certain things that you guys really need help with, throw those in the chat as well. All right, let's get started. Debits and credits. I do I interview every consultant still, even though we are 75 plus 80, somewhere in their range of employees. I still interview every consultant who comes in the door, the first initial interview. And that's because there's certain things that we're looking for, right? So the most important thing that we have here is a great culture, and we want people to understand what it means to work for Fourlane. So I find that as one of my most important roles is doing that initial interview. And one of the questions I ask on that interview is I ask people to do a debits and credits question. I say, if you are buying inventory, which accounts would we expect to see debit and credited? And then if you're selling inventory, which accounts are you expecting to see debit and credited, right? And this question I ask because debits and credits, if they have a grasp on debits and credits, they will do better, right? So understanding. Now, you don't have to be an expert in debits and credits. Debits and credits are super annoying. I actually say that. I'm like, sorry, I have to be so annoying in this interview to ask you guys these questions. They're super frustrating because you have to go back into your T accounts and like think back to college days or whatever it is, right? But luckily, QuickBooks helps us out a lot with this. And so I'm going to show you in product mostly. We're going to spend most of the time in product today. But let's just talk about it from a high level. So when I buy inventory, this is an asset account, most likely, obviously, if you're cash basis and all the things, but we don't really talk in cash basis over here because cash basis is not the best way to run your books to make business decisions, correct? Hopefully everybody understands that. If you don't, we can talk about that afterwards too. But I am buying inventory on an accrual basis. My inventory is an asset account. It is going to go up. That is a debit. Okay. And then how am I paying for this inventory? Either on accounts payable, via credit card, via check, something like that. So my accounts payable, which is also a balance sheet account, is going to go up also, right? Because the liabilities section has a positive credit balance. So it's going to be a credit to accounts payable. Okay. So I look at this $500 in the assets up, $500 in the accounts payable up, hitting the balance sheet only, right? Because this is an asset that I purchased. I have not utilized this asset yet. Okay, now I come into the sale of the product. So the first thing we think about, there's 2 steps in QuickBooks. QuickBooks takes care of 2 steps for you, which a lot of other ERP softwares do not do. And I'll talk about that. But the first step is we're relieving inventory, right? So we have to have, I had $500 in inventory come in. Now I'm having $500 in inventory go out. So that should be a wash in the asset. So I'm going to see that credit to inventory on the asset account. And what's the offset to that credit? Well, now I'm expensing this inventory because I'm showing the utilization of this inventory. So that's going to be a debit to cost of goods sold, our first transaction on the profit and loss is here, right? It doesn't hit the P&L if inventory is set up correctly. It doesn't hit the P&L until I sell it. So we're talking job costing. I want to know how much inventory I've purchased for a particular job. We have to go about that a different way if we're doing it with inventory. Okay, because it won't show utilization. It won't show cost. So it won't show up on a profit and loss by job until I use it or consume it or take it off my books, basically. So credit to inventory, debit to cost of goods sold. Oh, I spelled this wrong, look at that. And then debit to accounts receivable, right? Because at the same time as I'm selling it, I'm also getting revenue from this. So I'm debiting accounts receivable because somebody hopefully owes me something. If this is on a sales receipt, then it's a debit to cash, right? Probably, or a debit to undeposited funds or something like that. And then credit to revenue with an E on the end. Credit to revenue, okay? The revenue is on the P&L side as well. So in this sales transaction, I get my revenue. Let's say it's $1,000 because I have a margin in there. Revenue of $1,000. And I have a debit to cost of goods sold of $500. So my net on the P&L is $500. And we're going to look at this in product again, but I wanted to show it to you. So before we go into QuickBooks, one thing I want to make very clear. In most software outside of QuickBooks, and a lot of software, not most, depends, but in like an ERP software, so an Acumatica, as an example, they actually on the purchase do debit and credit. On the sale, on the invoice transaction, they do this part, hit sales, hit revenue. And they have a third transaction type, which is a shipment. And at the shipment, they do debit cost of goods sold and credit to inventory. Okay, so maybe it was shipped out on the 30th, but we're not invoicing the client till the 1st. The problem with that, and why a lot of these ERP softwares take a lot of time to have to reconcile inventory at the end of the month, is because those need to be happening in the same period. I need to have the sale, the revenue reflected at the same time in the same period as my cost of goods sold to have accurate reporting. Okay. So there can be a lag that we see. And if somebody comes to me in the interview process and they give me the purchase and that's correct, and then when I say on the invoice, when I sell it, they only give me this side, the bottom side, the revenue side, I know they probably know ERP really well, may not know QuickBooks as well. So let's get into QuickBooks and let's talk about what does this look like. Okay, the first thing I want to do is just go ahead and set up an item. I have a whole bunch of inventory parts in here. So we're going to set up an inventory item. And you can see in here, so we will call it a webinar part that we can remember. A whole bunch of things that you can set up in here, but the things that I really want to pay attention to are the accounts down below. So we have our cost of goods sold account, right? Which account is it going to hit at the point of sale? I have my income account. Which account, revenue-wise, is it going to hit at the point of sale? Revenue, cost of goods sold. And also, this should not, there's very rare, there are some weird times with internal usage of inventories and things like that where this is going to hit an expense account. Like if we are maintaining track through the inventory system of our internal inventories, we might hit like an office supplies expense account or something like that. But most of the time, if this is part of your normal business that you sell these inventory parts and make revenue on them, you're going to hit cost of goods sold. Okay, it should not be an expense account. And then down below, we have a third account. So this is what makes inventory different than anything else that we set up, any other types, right? Service type of item. We've got cost of goods sold and we've got revenues. In a non-inventory part, we've got cost of goods sold, we have revenues. The difference with an inventory part is we have this third type down here, which is our asset. So when I buy it, asset is affected. That's it, right, on this screen. Accounts payable, obviously, as we said, but asset is affected only on this screen. When I sell it, revenue is affected and cost of goods sold is affected at the point of sale. Okay, so that's why these things matter so much. Now, there will be future videos where we talk about some weird, crazy situations where we've seen people do not cost of goods sold, not revenue, not assets in this world, right? Because we've had to hit certain accounts. We've wanted to hit certain accounts at the point of sale. We've wanted to hit certain accounts at the point of purchase. And so we have figured out ways for clients to utilize the system, right? You're not forced to choose an asset account here. You can actually choose an income account down here if you want to. That's how people get really messed up though. But we have used the system and kind of fooled the system sometimes to get to that end result that we've needed to. Not going to go off that tangent today. Cost of goods sold, revenue, asset. Okay. So that's a setup of an item. I've got custom fields. Hold on, let me make these custom fields not required. Okay. Webinar item. So let's go ahead and purchase this item. If I go in and I enter a bill to Anderson's Hardware and delete all the things I pre-filled in, thanks so much. And I'm just going to buy this webinar part. Okay. Now, on my inventory screen here too, I am not, so in QuickBooks Enterprise, you can use enhanced inventory, which throws a little extra wrench in there, and we'll have a whole webinar on that also, but we do not have enhanced inventory turned on, right? So that's important to note. If you have an enhanced inventory turned on, it'll be slightly different in the debits and credits, but this is just normal off-the-shelf QuickBooks Enterprise. Actually, any version of QuickBooks Desktop is going to treat inventory in this fashion. Okay. In Enterprise, you can get into that enhanced inventory. It gets a little different. So I'm going to buy a quantity of 10. I'm going to buy them at a cost of $10 each. Yeah. I've got all the pop-ups. And I'm going to go ahead and say save. Now, this is what QuickBooks does that is so amazing to help us out. They actually keep track for us of the debits and credits of this transaction. So what I see on my screen here, like, oh, great, I entered a bill. Fantastic. But what is it actually doing behind the scenes? That's what matters. So I can come into my reports and go to transaction journal or reports down towards the bottom here. I used to say go all the way to the bottom. Now we got the PPP stuff at the bottom, but I can click on transaction journal and it's going to show me the debits and credits. This is one of the best things that QuickBooks does. I've seen some other softwares take this over, right, and make it simple to kind of pull up these debits and credits. But what is happening? Here is my credit to accounts payable. Credit to accounts payable. And here is my debit to inventory, materials inventory, and it's an asset account. Okay, so I see that happening there. Then, so I buy one for $10. Then let's talk about selling this item. Okay, so I'm going to go into my customers and create an invoice and just sell it to Baxter Street here and put in webinar part. Now, I didn't fill in what the sales price was and all those things here, so I'm going to say we're going to go ahead and sell 10 of these, and we're going to sell them for $20 each, so $200. Okay, and then I'm going to go ahead and hit save. Same thing here, behind the scenes, I can go up to reports, click on transaction journal, and we see 4 lines this time, just like we would have expected to see. So I have $200 debiting accounts receivable. So my accounts receivable number is going up on my balance sheet. Somebody owes me $200. I have $200 hitting pool cover and equipment sales, which is a revenue account. So that is going up on my P&L. I have $100 of materials inventory being credited. That means my inventory is now going down for $100. And my cost of goods sold is going up for $100 on my P&L. Okay, so QuickBooks, what it does that is so fantastic and actually makes it so much more simple for us to do inventory, is they take care of those debits and credits, all 4 of them, on the one transaction behind the scenes. Okay, so very, very simple. I try to keep it as simple as possible. Now let's see the results of some of these things. If I go in and I run a inventory, inventory valuation detail report as an example for all time, and I'm going to customize it and filter it just for the item of webinar part. So what happens in the inventory valuation side? So I see here, here's my bill on 12/15, $100. And here's my invoice, subtracting out 10, right? Bringing my quantity on hand down to 0, and bringing the asset value also back down to 0. Now I have left it, which is a standard, at average costing inside of QuickBooks, right? So average cost is going to take the average of any items on hand, and we'll look at that here in just a second too. But 10 in, 10 out. When I brought the 10 in, I had an asset value of 100. When I sold the 10, I had an asset value of 0. One thing to note as well when it comes to QuickBooks is the order here. That really matters. Because if I go in and I put in an invoice first, it will, so the way that QuickBooks functions is it goes in order by date first, date of transaction, and then the second thing is created or edited date. So if I come in here and actually make an edit to this bill, see, it keeps it in that order. Now, if I go in and I create another invoice, so let's go ahead and duplicate this invoice. Yep. And I'm going to sell these for, let's do $25 just so that we can keep track. Save and close. Now, let's see what happens is that next invoice I just created, it puts in there the average cost at the point of invoicing. So the only cost it knows for this item is $10 because of this bill up here, right? And so the secondary invoice that I put in, it's going to pick up and use that asset value of $10 because that's all it knows to do. Now, if I go put in a bill again, now, later, after the fact of putting in that invoice, let me put in another bill here, and to webinar part, a quantity of, let's say, 20 this time at $20 each. Now, notice the order of operations here. So again, knowing how QuickBooks is going to function is what matters the most. The order of operations here is based on date of transaction and then created date. So it says this invoice is taking the value of the inventory at $10 because that's all it knew at this time. And so the cost of this invoice is only picking up $10 per transaction, even though what we sold them, because really I had some in, they went to zero here. What I sold them was from this one that was $20 per. Okay, so it's not picking up enough cost technically because I put that invoice in prior to putting in the bill for the items. So something, again, just to be aware of, how do we fix these things? A couple things. We shouldn't be going straight to invoice most likely, right? We should be putting in a sales order. If a sales order was put in first, and then I got to actually invoice it at the point when I relieved my inventory and sent it out, it would have most likely been after the bill was put in the system or the item receipt for these items, because otherwise I couldn't have shipped them out. How would I have shipped them out if I didn't put the item receipt in? So normal business operations, this should not be an issue. Okay. So how do I correct this? It's actually quite simple. And again, QuickBooks does this really nicely. So you can come in and do two things. You can come in, delete this transaction and recreate it, because then the recreated transaction will be after that bill came in. Not really the best situation there. You also have the option to put in an extra date. So if I move this ahead one more day, it will correct the order of operations. Now that bill has come in for the 20 parts at $20 each. And you can see on this invoice now, instead of it picking up $100 of cost, right, it picked up $200 of cost. Because date matters first, and then created date when it comes to valuation of inventory inside of QuickBooks. Hopefully that makes sense. Okay, so it matters. I know a lot of people think, oh, I'm just going to put the bills in there, or I'm just going to put the inventory items in. I'll put all the bills in later. QuickBooks is expecting you to function the way that life functions or the world functions. I cannot ship out parts until parts are received. And if we are not functioning in that way, then we might have some issues with our inventory costing. Okay. So it's always important to know what is happening behind the scenes. Now let's go in, since we have this fixed now, and it looks a lot nicer, right? Now let's go, and by the way, there is going to be a webinar coming up, and I'll show you my future webinars, but about negative inventory in QuickBooks. I know people probably know how to fix negative inventory. You can go in and do an inventory adjustment, understood. However, QuickBooks does not like it, as you can see there. QuickBooks does not like it if inventory was ever negative at any point in time. So technically, when this invoice was above that bill for that, split 30 seconds, inventory was negative because we did not have the bill, we did not have the items received yet at the point when I sold this invoice. So technically, it was negative at one point. And we try to, with our clients, we figure out how to work with them on having inventory never be negative. And there's so many different processes we come up with. So everybody says, there's no way I can do that. It's going to stop my revenues from happening. It's going to stop production. It's going to stop, we hear all these things, and we've figured out ways to make it happen. But this is what we want to see. Items in, items out, items in, items out, not items in, items out, items out, items in, right? We don't want to see it like that. Okay, so we looked at here, this is the inventory. So this is the asset, the modifications to asset. At this point, we have 10 inventory items left on hand, right? Because I bought 10, sold 10, bought 20, sold 10. So I have 10 left at a $20 valuation each, because it's picking up average, right? I bought 10 at $10, I sold them at $10, it went to zero. I bought 20 at $20, I sold 10 at $20, now I'm sitting at $200 asset value. So this is the asset value that's sitting on there. So if I go look at my inventory valuation summary report, this is the inventory valuation that we will see right on here. Now, this is as of 12/15. Remember, I sold it as of 12/16. So when I moved to 12/16, I've got 10 at $200 asset value. Okay, so that's what the balance sheet looks like. Now, this doesn't talk about the accounts payable and accounts receivable. I'm not really focused on that because that part's kind of easier to understand. Let's take a look at the P&L. So if I come in here, there's a couple different reports that we can run. So we have sales by item summary, right, which will give you the revenue side. But we have actually an item profitability report, which is really nice to see. So if I come in here and I look at my item, this is for all time item profitability. So for all time, I have $300 in cost, which makes sense, right? We have $200 on the second invoice, $100 on the first one. And I have $450 in revenue on this item for a total of $150. Now, that's not how much cash basis I have on this item, right? Because, I mean, obviously, they're still sitting accounts payable. So, but let's pretend I paid out my accounts payable for those items. I should have $500 in costs, right? If I think cash basis, because I have $100 on the first bill and I have $400 on the second bill. But what this cost is showing is realized costs. So I have $200 in future costs that I will take when I sell those additional 10 sitting on the balance sheet in that asset account, plus the $300 that we've already costed out. For the $300 that I've already costed out, I've received $450 in revenue. So that provides my margin, right? I made $150 on this so far. Okay. So one way to see it, item profitability. You can also go in and do profit and loss. And you can do a profit and loss total by item detail, actually. And again, I wouldn't do this with all of these showing up on here. So this is showing this month to date. I want to show for all time. Yes. Scroll on over to our webinar. So you can see here, I've got $450 in revenue. I have $300 in expense, so exactly what we saw before. But you can see it now in the P&L. Revenue, $300 sitting in cost of goods sold. And then my bottom line down at the bottom, because I have nothing else associated with this item, no expenses, anything like that would be associated with this item. I have $150 in revenue. So you can see the same thing hitting here. Okay, so that's the end result. All right, I only have 1 minute left here, so I just want to revisit and go back. Debit to inventory, credit to accounts payable. When we sell it, this is going to hit 4 accounts. Okay. Coming up in the future courses, next week, we're actually going to talk about cycle counts. I know we're heavy debits and credits this week, and we're going to go into some of the fixing of those things later. Hopefully, this helps you to understand how inventory functions a little bit better inside of QuickBooks. Next week, we're going to talk about cycle counts, though, because it's that time of year. Hopefully, we're all planning for cycle counts before year end. So we're going to talk some tricks to make that a little bit easier in QuickBooks this year. Then we're going to go into build to stock versus build to order. So that whole thing about using sales orders versus assemblies, stated costs and assemblies, landed costs. So you see some of the stuff coming up. As a reminder, some of the things that we do here at Fourlane, This is the time of year where people start looking at their processes. Are we doing things the most efficient? Are we doing things the most automated? Is our data set up to give us decisions in a timely manner, right? That's the biggest thing that we want to focus on with clients. We had to do a lot of pivoting over the last couple of years, a lot of short-term micro decisions to make big impacts inside of companies. And the only way to be able to do that comfortably is to have data. So that's what we always want to focus on. Okay, guys, sorry I'm running over. Thank you so much. This is Margie Adams again from Fourlane. I hope you were able to take something away today, and I'll go ahead and work on some questions here. If I can't get back to you on questions, by the way, I will, as I mentioned before, email you after this webinar. All right, thanks, guys.